There are, of course, plenty of stocks out there, but that doesn't mean all of them are good buys or cheap right now. Many of them are not. Today, I think I've found 4 stocks that are relatively cheap, and I'm going to make that case for you today as to why I think that is the case. I'm covering 4 separate categories to give you guys a variety as well, so we aren't just looking, oh, this sector's cheap, so we're just covering that. The first one we're looking at today is John Deere, or Deere Company. They're up 141% over the last 5 years, compared to the S&P 500, which is a good benchmark. That's up about 100% over the last 5 years. And its P is about 30, forward P is about 23, which is just the amount of profit it brings in compared to how it's valued. So the forward dividend is 1.45 as well. That's a bit above. But the PE ratio, 16.5. So right now you're getting a company that's nearly half PE, and it's outperformed the S&P 500. That signals to me that it's fairly cheap. Now, forward PE isn't as impressive at 22 compared to the S&P 500, which is at about 23. This is still a company that you're getting that has outperformed and is cheaper by PE and forward PE metrics. Now, the market isn't looking as good. They're, believe it or not, because they make tractors, they're tied a lot to, okay, is corn worth more? Is soybeans worth more? So there's going to be some volatility there. However, they've really stagnated since they grew a lot pre-COVID, and they really haven't grown a whole lot. And this is a company that really is valued at a company that isn't expected to grow a whole lot. So even if it ran sideways for a year, you would get a decent dividend. And I think sometime in the next 2 to 3 years as a long-term hold, Deere is going to perform pretty well. Historically, it has returned these earnings, even since 2015. Early 2015, you're up from 90. So this is a company that's outperformed on the 5 years, on the 10 year, and I expect it to probably going forward in the future as well. We're looking at Kroger next. I think Kroger is a relatively cheap buy. It's outperformed the S&P 500 as well, up about 112%. Also, the dividend it's over 2%. So it's the S&P 500 dividend, if I didn't mention, is about 1.3. So it's definitely outperforming on multiple metrics. This one is especially cheap, though, where you didn't have the forward PE as low. With Kroger, you definitely get it. The PE is 16, forward PE is 13, so you're basically half price on both PE and forward PE. Just a little under for forward. 23, half of 23 is what? 11 and a half? Yes, 11 and a half. So you're just above half value. So also, for a recession hedge, and that's not what this video is about, but you would expect a retail chain like Kroger to be pretty good in a recession. They sell basic, goods and things like that. Walmart, you would expect to do well, although Walmart is valued like a growth stock. It's valued at like 45 PE, which there's nothing wrong with growth stocks. But Kroger is a cheap stock that's probably going to hold up better in a recession, and I like it for that as well. Because we aren't necessarily, at least for me, I'm not, when I invest in a company like Kroger, I don't expect it to outperform too dramatically. But if it does, that's great. I also want it to actually protect me, if there was to be something not good going on. Also, if there is something not good going on, like a war, Lockheed Martin would probably perform pretty well. This is a stock that it doesn't look super impressive, at least compared to the others. The dividend, though, is much higher, 2.7. If you compound that, it's going to look a lot better over the last 5 years, over the last 10 years. If you zoom out on Lockheed Martin, it does look a bit better, though. Since early 2015, the stock was at about 200, so you've actually performed a bit better. Like I said, if you factor in the dividend that you had during this time period over the last decade or so, you've probably performed right around where the S&P 500 has over the last 10 years, which is up about 200%. Your on share price alone, you're at from 180 to 500, so 1.5 or 150, something like that. But if you factor in dividend, you probably get to that mark. Lockheed Martin, of course, sells lots of war stuff. So in the event that there is a war or something like that, they're going to do well. And they've historically done well, and you'll get a decent dividend on top of it. But also PE, of course, 17.5. That's pretty cheap. If we look at the forward PE, it's right around flat. So that's part of the reason it hasn't gone as well. It's not really growing over the next year at least, but this is still a stock that is certainly cheaper than the S&P 500, and over the last decade or so, it's right around performed that. It's also good diversification. I'm assuming most of you don't have a bunch of defense stocks, and defense stocks, I think having a little bit exposure to that is never a bad thing, even if there's some underperforming there. And then lastly, Goldman Sachs. This stock is up 150% over the last 5 years, although a lot of that is over the last year. Nothing inherently wrong with that, but it's a little bit interesting when you get a stock that's pretty cheap, but also has had a big run up, at least over the last year. That just shows you where it was at. There's also a good dividend with this, over 2%, and I assume even a year ago it was much higher than that. One thing you do have to factor in, specifically with large financial excuse me guys, financial institutions, is that generally they trade a bit cheaper. They have historically since after 2007, a lot more regulation on banks. I'm not arguing one way or another there, but that is just fact. So they do not grow as much and they have lower PE valuations. However, Goldman Sachs and there's a few others have outperformed the market during this time period, which is impressive. It really is. Also, like I said, the dividend on top of that's good. But if we're looking just broadly at the market and maybe not at the sector itself, this PE is cheap. You have 17 and then 14 for Ford. So you're way cheaper than the market or the S&P 500, which is generally quantified as the market. So you get a stock that is cheap. It's outperformed. It's cheaper. But you do, like I said, you do have to factor in you're probably never going to get a stock like Goldman Sachs to trade near 30 PE levels. And you can get something like any of these others too. If they start performing well enough, there is a historical precedent for stocks in these sectors to have PE valuations higher. So like in a good scenario, you may start growing faster, and then if that PE gets near 30, you've made quite a bit of money on top of that. Goldman Sachs, you probably won't get that. However, it's still a stock that has performed well. So it fits into this video. Anyways, guys, I hope you enjoyed. That's all I have for today. If you enjoyed, like and subscribe. I do daily stock content on this channel, and I appreciate all of you for watching. I'm also out of breath if you don't notice. But anyways, that's not important.